Let's get oriented. I'm Lazaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Tuesday, May 26, 2026. The market is entering this shortened trading week with three major pressure points: oil, inflation, and interest rates. U.S. markets were closed yesterday in observance of Memorial Day, but global markets, bond yields, oil futures, and geopolitical headlines continued moving behind the scenes. Notably, while markets were closed, oil futures retreated from recent highs as a sign of possible diplomatic de escalation in the Middle East began to emerge. That has temporarily relieved some inflation pressure heading into Tuesday's opening bell. But this remains a wait and see situation. The market may be pricing in diplomacy, but until physical oil flows through the Strait of Hormuz fully normalize, a single headline could quickly bring the oil risk premium back into the market. So now let's recap last week. The Dow Jones Industrial Average closed nearly 50,579, continuing to hold above the historic 50,000 level. The S&P 500 extended its winning streak to 8 straight weeks, while the Nasdaq remained supported by artificial intelligence and semiconductor leadership. But last week was not just another technology rally. It was a test of whether this bull market can finally broaden beyond the largest mega cap names. And for the first time in a while, we saw encouraging evidence of that. The Russell 2000 surged roughly 2.7% last week, outperforming many large cap areas of the market. And that matters because healthy bull markets usually require broader participation across sectors and company sizes, not just a handful of leaders carrying the indexes. Technology still mattered, and NVIDIA remained at the center of the AI conversation. The company delivered another massive earnings report fueled by record data center demand. But despite strong results, the stock cooled afterwards, and that's an important signal. The market is no longer rewarding every earnings beat automatically. Expectations are already extremely high, and investors are beginning to ask what the next catalyst will be beyond the current AI hardware cycle. Meanwhile, we're also seeing rotation into companies building the infrastructure around the AI boom, not just headline names themselves. Bond yields were another major story last week. The 10-year Treasury yield recently traded around 4.54%, while the 30-year Treasury yield touched roughly 5.2%, levels not seen in many years. And that 5.2% level is not just a number. It raises the hurdle rate for the entire economy, from homeowners facing higher mortgage costs to companies trying to refinance debt and expand operations. When long-term interest rates rise, borrowing gets more expensive, valuations become more sensitive, and investors become far more selective. Now let's look ahead. This week I'm watching whether lower oil prices, Thursday's inflation report, and the Federal Reserve's new leadership tone can keep this rally intact. Tuesday marks Chairman Kevin Warsh's first full business day leading the Federal Reserve after being sworn in on Friday. Markets will be listening carefully for signs of institutional clarity, inflation, discipline, and how aggressively this Fed may approach balance sheet management moving forward. In plain English, investors want to know whether this new leadership team will remain restrictive longer than markets had previously expected. The biggest economic event this week arrives on Thursday, May 28th, with the release of core PCE inflation data. Mark Thursday on your calendar. Core PCE remains one of the Federal Reserve's preferred inflation gauges. If inflation comes in hotter than expected, especially with long-term Treasury yields already elevated, markets may need to rethink how quickly the Fed can pivot toward easier policy. Geopolitics also remains front and center. The Middle East, Iran, and the Strait of Hormuz continue to matter because energy markets remain deeply connected to inflation expectations, transportation costs, and consumer spending. Even with signs of diplomatic progress, this situation remains fluid. Now, here's the bigger picture for you. The question is not whether the headlines are good or bad. The question is whether your portfolio is built for the environment we are actually in. If you have a higher risk tolerance, opportunities still exist in areas tied to artificial intelligence, technology, infrastructure, industrials, and sectors benefiting from improving market breadth. But this is not an environment for emotional trading or chasing headlines. Discipline, diversification, and high risk management matter. If you have lower risk tolerance, this environment continues to reinforce the importance of balance and preparation. Higher interest rates are creating opportunities in cash management, short duration fixed income, and conservative income strategies that simply were not available a few years ago. At the same time, inflation risks remind us why preserving purchasing power still matters. For everyone, this remains a market that rewards planning over prediction. Oil will move, yields will move, headlines will move, but your financial decisions should remain anchored to your goals, your time horizon, your risk tolerance, and your overall financial plan. Stay focused, my friends, stay disciplined, and as always, stay oriented and elevate your legacy.